Netflix replaced its own DVD revenue before the market forced it. That is proactive cannibalization. They were lucky early adopters, proactive self-disruption, a subscription pivot, and platform scalability. Today, we dissect the exact risk signals they ignored and how you avoid the same mistake. At its pre-streaming peak, Netflix appeared to be an unassailable fortress in the home entertainment market. The company commanded a massive subscriber base, with millions of households awaiting those iconic red envelopes. Revenue streams were robust, consistent, and growing at a healthy pace. It vanquished Blockbuster by creating a more convenient business model. To many observers, Netflix's position looked secure. The business was straightforward, the brand beloved, and cash flow predictable. This perception of safety is a common trap for market leaders. Institutions bias toward optimization, trimming costs, and incremental improvements. The path of least resistance was to coast on DVDs, while streaming matured. Instead, leadership traded short-term certainty for long-term relevance and funded streaming from DVD profits. To systematically analyze Netflix's strategy, we use the self-cannibalization rule. It's a lens for examining vulnerabilities when a company replaces its core business. We are evaluating this collapse across 3 structural dimensions: legacy revenue replacement strategy, how new revenue replaces old without a cash flow gap, scalable platform architecture, whether the platform truly scales without hidden costs, adaptation timing, advantage, the durability of moving early as rivals enter. If you value structured thinking over surface-level advice, this channel is built for you. These dimensions illuminate how survival strategies can introduce new points of failure. Risk 1. Replacing the cash cow. The plan to phase out a reliable income source and replace it with an unproven one. A successful strategy grows new revenue fast enough to cover the decline. A flawed plan creates a perilous financial chasm. Netflix had to keep servicing profitable DVD customers while pouring resources into a loss-making streaming service. It split focus, briefly its brand, with the Quickster decision. DVD profits funded the streaming experiment. Netflix underestimated how fast content costs would rise and how angry customers would be as DVDs were deprioritized. The gap widened faster than expected. Exclusive content bidding with big media drove fees sky high. Subscriber growth became a necessity to cover fixed content costs until growth slowed and the economics cracked. New subscriber revenue couldn't offset massive expenditures on content and infrastructure. Dependence on debt increased, and the stock price became extremely sensitive to subscriber numbers. But here's where it became dangerous. The strategy swapped a stable, high-margin business for a volatile, capital-intensive one under harsher market scrutiny. Risk 2. The hidden costs of scale. The scalable platform architecture. Technology, product design, and operations must support growth. True scalability drives marginal costs towards zero and boosts profitability. Poor architecture hides costs that balloon with users. Netflix needed a massive global server network, the Open Connect CDN, and a constantly refreshed content library. Streaming's architecture was fundamentally different from DVDs. DVD costs scaled linearly and predictably. Streaming carried 2 major scaling costs: content rights licensed regionally and time-limited multiplied with global expansion. Data delivery costs remained material, the missed signal, assuming software-like economies of scale. But here's where it became dangerous. Complexity and obligations exploded across 190-plus countries. Studios pulled catalogs to launch their own services, forcing costly originals. Serving new markets often yielded less revenue without lower per-user costs. squeezing margins. Risk 3. The perishable advantage of timing. The adaptation. Timing advantage. Moving early can capture share, set default status, and create network effects. Netflix's aggressive move into streaming built that advantage. The missed signal. Timing is a temporary moat, not a permanent one. Well-capitalized competitors learned fast and replicated success. But here's where it became dangerous. So, studios stopped renting their moats. They entered directly and cut off the content supply that helped Netflix grow. Offerings converged, often subsidized by larger empires. Competition moved from convenience and tech to content, an expensive battleground. Rivals bundled and leveraged vast ecosystems. UX tech lead shrank. The fight became a costly war of attrition. The first mover edge expired. Defense demanded an ever more expensive wall of content. What early signal do you think they ignored? The turning point was a slow realization. The growth assumptions had changed. Revenue replacement pressure met platform costs as the timing advantage evaporated. The market re-evaluated Netflix as a capital-intensive media company. Collapse is rarely sudden. It's structural. Build redundancy before you need it. Use the optionality readiness score. Number of income channels, judge your core financial needs. If your income sources equal 1 and expenses are rigid, your resilience is thin. The 3-step resilience shield. 1. Develop a second monetizable skill. 2. Keep fixed expenses below 60% of income. 3. Maintain 9-12 months of liquidity. 30 days. Diagnose exposure. Count your income sources, list fixed and variable costs, calculate your optionality readiness score, and identify your weakest link. 60 days. Begin structural adjustments. Start the second income stream. Cut one non-essential fixed cost and move savings into liquid accounts. 90 days. Grow the new income source, reduce your fixed cost ratio, and build liquidity toward 9 months. Change happens through steady, deliberate transitions. Bold moves aren't risk-proof. Rigorously check replacement strategies, question true scalability, and never assume a head start is permanent. But what happens when dominance creates overconfidence? In the next Corporate Risk Autopsy, we examine BlackBerry and the complacency bias.